Hi, Dylan. Thanks for joining me and for agreeing to be on this podcast. I think Dylan is an entrepreneur, family man who I've known for many years, but I think it's probably better if he explains who he is. So, yeah, if you could tell us a little bit more about yourself, Dylan, what you get up to.
Yeah, thanks for having me. Some of my background, I guess, I was in corporate for over 20 plus years, working across mostly financial services and then healthcare, and then realized that I wanted to have a different adventure and not finish my story sitting in a corporate chair. And about 7 years ago, started exploring the world of startups. And that's been my journey now for the last 7 years, which has been very interesting, very challenging, much more challenging than I thought it would be, to be honest. As a person, I am happily married. I have been so for almost 25 years this year.
Congrats.
I think it's an expensive one. That's all I remember. Father of two very young kids. So I'm currently 48, so nearly 50. But I have a 6-year-old and a 12-year-old. So, and I think that's quite relevant, by the way, because obviously, when I think about my financial position, when I started working in corporate, I was a very young executive, and a lot of my colleagues were like in their, let's say, early 50s, and most of their kids were like at varsity, and I'm like, holy cow, I'm turning 50 and my kid hasn't even got to school yet, So, but it seems to be the trend, So I think, at least I don't think I'm the odd one out anymore. When I look at the drop off, I'm not the oldest. Or not unique in my age amongst the fathers, So, but I think this is important context, because obviously one of the things that I have to solve for now as a late bloomer, as far as parenting goes, is the financial journey, to support my family through what would have been traditionally the years where you were banking big time, because you'd kind of expensed all your main things, your kids were at varsity and so on. That's not my story, So I think there are other people out there with a similar journey or story, and hopefully this will be interesting to them.
Yeah, I hope so too. I'm a little bit further down the road, 10 years older. My kids are hopefully going to be finished varsity very soon, but they're not on my payroll anymore, so which is very good.
That's a good way to look at it.
And no debt. So yes, I'm a little bit further along in my journey, but I think this is really just to try and get a sense for how you handled that transition. So I mean, I know well, and I'm a bit later moving across into into the entrepreneurial world, having been less than a year on my journey. But I know in the corporate world that most of those things are sorted out for you. I mean, if you're working for a large company in the financial services sector, you have a retirement funding vehicle. You have group risk benefits and a medical aid. Generally, that would be the package. So now you, for the last 7 years, have been on your own, but I think it's more that transition that I'd be most interested in, is how did you go from having your life sorted out and having a regular paycheck to a very different world, and how you manage that?
Yeah, probably not well. So, if I'm honest, it wasn't top of mind when I decided to make the shift, right? In fact, that's probably one of my biggest learning lessons, really, is that I didn't really apply a lot of my mind to this aspect of my life. I mean, as you rightly say, if I think back now, when I was in corporate, a lot of the benefits or future planning and products that we were sold, or the comfort or security I had, was actually taken care of for me. I had the benefit of it being bought as part of a bigger company, so obviously we got very good pricing and rates for that. We got good cover limits. There wasn't a lot of sticky issues around it. But I do think when I reflected on this a little bit is one of the things I could have also still done better while I was in corporate, funny enough, was I didn't maximize the benefits of building out retirement annuity-based investments. You know what I mean? Like, so a lot of times companies will, for instance, match, and I think even now, like, and when I was at an executive level in these companies, I didn't really think about that. Again, one of my reflection points was I didn't realize to say, hold on, if I upped certain things, the fact that the company was then offering or matching some of those things, honestly, I didn't take advantage of that, So that's probably one of my, when I reflected back now, thinking, wow, I could have done a lot more, and I could have probably leveraged and designed the benefits differently. So on the one thing, it was great, somebody else looked after it. On the other thing is I trusted them way too much, in the fact that I thought that they were actually looking at me as an individual, but actually they weren't. They were looking at 3,000 employees. I was just one of, in fact, we were probably close to 20,000 employees. So that was the one thing. In the transition though, here's the cool bit. Well, I think I got some things right. So when you leave a corporate, and even when you change jobs, from one corporate to another, you get to make certain decisions around those benefits and those sums. So it's not like all the money I was paying, especially to the Provident and then pension funds, that combination of the two. You then get given that you don't get given the money, but you get given a decision maker, right? Like, it's quite a critical decision. Even when you change employers or when you then leave employment, formal employment, you have to then make some very important decisions. I didn't realize actually how important they were, but obviously there's massive tax implications. If you then get to decide more for yourself as the individual, what do you do with the money? Do you put it in an aggressive fund or conservative fund, and so on and so on. And probably the biggest mistake I think I made at that stage was when you exit, you then have to get your own financial advisor, essentially, right? And I didn't realize how important that single decision is. So I wasn't ruthless and I didn't recruit properly in finding the best guy. I just found a guy. And typically the guy that I was given was already in the mix from the company, So there's this sort of deal where you have to exit those company group schemes or products, but you don't have to necessarily leave the supplier. Let's say it's Discovery or a Sanlam or Old Mutual, whatever. So you can stay in that family, but you still have to become an independent. And then they will advise you and say, listen, here's the Discovery guy, advisor, and then you just get pushed to. And that was probably my single biggest mistake, if I think about reflection points, right, is I probably should have taken a lot more time in deciding who was going to help me navigate just that first step. Yeah.
Did you preserve the money?
Yes. So yeah. So I will say it wasn't because of the advice I got, by the way, but I did realize, and I think my advice to any entrepreneur who transitions, doesn't matter how old you are, by the way. In fact, I think it's worse if you're older, because you have this pot of money now, right? Is do not touch it. Do not use it for working capital. Don't use it to invest in your new, venture, etc. Don't do it. It's like a bad idea. What I did do is I did take a portion of the money and I put it into quite a creative structure, which allowed me to, at a very tax efficient way, draw down on some of the money or the interest of some of the money. So we put some of the money into an interest-bearing mechanism, and I was allowed to use the interest off that, not use the capital portion per se, whatever. And then that paid me a bit of a stipend monthly, because obviously I knew I wasn't getting this nice, predictable salary every month, which is not how the world works in the entrepreneurial space. So I said, okay, look, let me take some of the money So in fact, I should say I did use some of the money, to be fair. But I used a very small portion, I think less than 10%. I put in a special vehicle, used the interest, drew down on it, and I think there was like 40,000 rand a month I gave myself, and yeah, then had to use that to pay my way until I could find a paying gig, But the transition that's the first step to the transition, right? It's, just realizing that you're going to get some money out, or you're going to get some money, and then you've got to decide whether you can use it. Now, I don't want to get into this new legislation.
The two-pot or three-pot system. Yeah.
Yeah.
Let's leave that for a different conversation.
All I can say is resist using any of it. Again, because if I look at 7 years now, and even that little bit that I used, obviously now, I've lost the compound factor, of the 7 years and putting it into other instruments and so on. And I mean, I know it was necessary, but I could have not done it, or I could have stopped it earlier.
Sure.
Yeah, and I didn't. So that's probably one of the big things. Post all of that, I think the toughest thing as an individual, and even moving into a business of some sorts, is the fact that your world is really very chaotic, financially chaotic in a way, right? Because it's feast and famine. You don't get this predictable cash flow. Cash flow is a big thing, right? For your business, but actually more importantly for your home, for yourself. So you've really got to watch that cash flow very carefully. You've got to look at you almost got to run your personal finances, or like you say, your income statement. You've got to almost run yourself as a business, your family, your financials as a business as well, and actually also have a view of your balance sheet as an individual. And that's a great way to think about it, because that's how you should think about your business anyway. So if you can't do it for your business, or you can't do it for yourself, you're in trouble. I at least had some basics, of understanding balance sheet and income statement and all the rest of it through both my corporate experience and obviously through some of my education. But what I struggled with isn't looking after that. I think what I got wrong, or didn't again get the best advice on, was what do I do with these risk products? So if I looked at the financial planning aspect of, the balance between some form of retirement savings versus some form of immediate risk cover, and that ratio, I almost went 90% into risk coverage, right? And almost very little into retirement. Now, why that was bad for me at that stage was when I left, I was just 41. Do you know what I mean? And if you look at typical saving retirement curves, normally from about 40 to 60 is when you're earning a much better salary. Generally, your cash drawdown is less, so you've got a little bit more to top into that, especially if your kids are older, which mine obviously aren't. And you can squirrel away more. So I think that's one of the things I definitely didn't even think about. Again, neither did my advisor. The guy didn't come back to me and say, listen, dude, you're 40 or 41, you've got young kids. In fact, we had the second kid on the way already, and that wasn't factored into any discussions at all. It was just, listen, how much money do you want if you die? I'm like, okay, then you do the basic calcs. Well, do I have a bond? No. What will life cost in the year 2050? And then you kind of pick a number and you say, okay, cool, that's what I can either can afford relative to what I think I need. And it really wasn't smart, not at all.
Okay. Yeah, I mean, one of the things I've noticed through this journey and looking at products and processes that are out there is that very few people know how to figure out how much insurance they need. Because I mean, the comment you made was how much you want, which is kind of, you should start with how much you need and then say, okay, I need whatever, I can't afford it, or okay, fantastic, I can. And also that the majority of, if we just think of life cover, you know, if you were to die, the majority of life cover needs are income based, but everyone in the market sells lump sum benefits. Now, we won't go into why.
Yeah.
But I mean, I think, you mentioned debt. So clearly debt is a lump sum need. State duty, if you have a lot of money, is obviously a lump sum need. And if you want to leave a legacy for your family.
Yeah.
But everything else, I mean, if you were to die, you would want your kids' schooling to be paid. So that's what, 15 years worth, but it's an income stream.
Especially because my kid hadn't started school.
Yeah.
I mean, that's a big number, right? I mean, I calculated, to your point, the school fees to get both my kids, not even through varsity, that's a totally different number. Just to get them through schooling was 3 million in total, which is like when I went to school, it cost a few thousand, right? Like my entire degree, I think, cost 30,000.
Yeah.
Now, first year varsity is somewhere between, if it's got res or, you know out of res, but I mean, it's anywhere between 200,000 to 400,000, right? And then you've got to times it by 3, assuming they don't do an honors and so on and so on. So, like, it's exactly the point, right? If I look at, for instance, what I was sold, let's do some on the risk cover side of things, most of my premium was in the life, in the life benefit or the life cover. So, I mean, I think I was paying 9,000, and between me and my wife, we're probably paying 13,000 Rand a month on life cover, right? Not on critical illness or income protection. And it's like, that was so stupid, you know. And obviously the reason why it was done is because somebody made a good payday out of selling me 13,000 Rands worth of I'm not going to say who, but I mean, definitely somebody benefited. It wasn't me.
Well, yeah, you did benefit to the sense that
you
were protected.
Sure. Yes. But if I retrospectively look at, for instance, having balanced the portfolio differently, and what I have out of 7 years, and I mean, if you think about it, 13,000, times 12 times 7, that's about R1 million, more or less. I don't know, I'm rounding up badly, but with a bit of interest and so on. So if I'd now said to myself, okay, listen, if you said to me, in the next 5 years, how would you spend $1 million? Where would you want to pocket it? I would have decided things very differently. Yeah. And I mean, even as an entrepreneur, what is quite interesting, and this is, again, a limitation, I think, both on the banking side, but also on the financial products, is how do you protect income if you have an uncertain income view of the world, right? Because they want evidence to say, well, we'll price you at this of your current income, and then and then they want to know what profession you have, how certain. It's very difficult to do income protection, as an example, just because of the mechanisms behind it. And when you're an entrepreneur, day one, you may have zero income, or very little, because you're trying to use some of your sweat equity to grow your business. So you're taking a very, very small, very small income, per se.
Yeah, look, I mean, I think the whole income protection is a difficult space for uncertain variable income. I mean, and there've been horrendous stories globally of because there is an anti-selective element involved in it. So if you say, I'm worth 40,000 Rand or whatever, and then suddenly your business isn't working and you can't do something, not talking about you specifically, but the generic thing, if all of a sudden someone's got a problem with their mental health or their back is sore or whatever. And I know I've seen examples of this having worked for reinsurers where I think it was the medical profession where these doctors were insured at a certain level, and then for whatever reason times were tough and they weren't earning any income, and they all claimed on their disability and got paid out these massive things. So it is a problem. I understand the problem. And there are some solutions, but there aren't any perfect solutions.
Especially not for entrepreneurs. At least that's my perception at the moment, or still, is, as an entrepreneur, you have this massive uncertainty as to will this business succeed? And if so, how much can I draw down as income, right? Because that's the kind of thing that the insurer wants to know. Say, listen, and by the way, what I do see now is that income protection is the most expensive of all the cover, right? So if I think about what I'm paying at the moment, because I did up the let's call it critical illness disability stuff, but it's really expensive. I think about 30 to 40% of my premium is now on those product sets, which I'm not sure is any better, because I also can see a big argument coming. You know, if for instance I'm not getting paid or something goes wrong, and then it's like, well, yeah, because the other way that the impact on the premium is it 3 months or 12 months? You know, was it 7 days or a week? You know,
you mean the waiting period before the benefit?
Yeah, exactly. You know, like, and I've never claimed for it. Like, I guess most people don't go in to buy these things understanding how to claim it. But I think that's the other thing, you know, it's like you've got these benefits, but yeah, whether you can actually end up claiming for it, or at least showing that it's, you know, it's a valid claim and so on. I haven't even gone there yet.
So most of the modern generation income protection products have what I would call have an underpin. So in other words, the old definition was, can you do your job, yes or no? And there's a lot of subjectivity involved there. And if you can, you get paid, and if you can't, then you don't. But a lot of the modern products will have, like, you can call it a critical illness or a functional impairment underpin, which says, if you have this, we will pay. Then they don't even, if that happens, they just tick a box and say pay for whatever the period of time is. It could. Yeah. So
that's the easier of the two, to be honest.
It's a lot easier.
Yeah. If you have a heart attack, a stroke, or get cancer, whatever the case may be, you can prove it, right? But on the income protection side, it's like if your business goes bust or it's not able to pay you, then I haven't had that argument yet. I'm actually thinking I need to go and try and have it, because there is instances where, you know, if I think currently we've forgone salaries now for the last,
but that's
9 months, right?
That's a different concept. That's not disability income protection. That's
the issue. Yeah, that's exactly right. That's the problem, right? Like, that's actually what you want, but what you bought is like, if your health fails you, not if your business fails you.
Yeah, I mean, then you're talking about retrenchment or unemployment cover, which is available. I'm not sure it's available for entrepreneurs. I would suspect not.
No, look, it's quite interesting, because when you become an entrepreneur, you sort of join a club, right? It's not a great club to be in, but let's just say you're in the club now. And I mean, you start networking and you start talking to entrepreneurs from other countries. Like, for instance, I've built up quite a fair amount of relationships with guys in Europe, as an example. And in Europe, if you're an entrepreneur, you're just not insurable. They just don't insure you, that's it. In fact, the entrepreneurs there spun up their own mutual fund to look after themselves as a club. I don't know what benefits they were looking at specifically, but I mean, this is a good example. You know, like, let's say if your business hits a dry spell or you can't pay yourself, tough, you know, you just got to live with it. I think all of this is quite, you know, if I reflect on this complexity we're talking about now, you have it in two, you know, you've got to think for yourself and your family, and then the minute you start employing people and you have employees, the complexity increases, because the question, and most entrepreneurs will say, listen, there are no benefits. It's total cost to company, I give you your salary, good luck, you know, go out there into the world. But that's also not really great, right? Because most of the guys that we are able to hire are normally youngsters that are inexperienced in life, just out of varsity, you know, because they're willing to work and be part of a journey and an adventure. But it's not really great as well as an employer to say, dude, you're on your own, and not be able to say, listen, whilst you are getting paid across the company, because I can't actually give you any benefits, here's at least some things, you know, you can think about. And, you know, if I think about it, there is no handbook. A lot of what I've experienced, at least, was trial and error, more error than not. Talking to others, you know, hoping that somebody else can give you at least their some advantage or whatever. But in truth, when I look back on this whole space, there wasn't great advice. Because again, most of the advisors or the people out there giving advice are used to corporates, employees, you know what I mean? They don't really deal with...
So there's an opportunity here for someone.
I think so. Maybe I should rethink my business.
On the retirement saving side of things, I mean, when you left, you said you were putting the majority of your funds towards risk benefits and far less towards retirement savings. I mean, there was an article the other day I read, and I mean, the assumptions and everything were reasonable, but they were saying how much you need to save to retire, and it looked at different ages, I think, like whatever it was, 25, 35, 45. It's quite depressing, but at 25, based on the set of assumptions, the answer was just under 12%. I think it was like 11.85 or something like that percent. And by the time you got to 55, this is assuming you hadn't, which you obviously have an existing decent pot of saving from the corporate world. This is assuming you hadn't saved before. By the time you got to 55, in order to reach your 75% of your income in retirement, I think you had to save like 98% or 99% of your salary. So I guess and it is, I think it is more difficult to do it via a retirement annuity than, because the other way, you don't even think about it. Your employer just takes the money off.
And they add to it. Most of them will add 5% or 7%, depending on the company. Look, I think if I think about when you're now at that precipice of deciding to exit corporate to do your own thing, right? Because I mean, we've both gone through that process. That's where I didn't get the best advice. In somebody that said, dude, if you do it now at 40, knowing your situation or whatever, and you are going to be taking a, what's the word I hate is, or whatever, like some sort of... in putting money into that, let's say for 10 years, right? Because at some point you either got to make it or you got to go back. Okay, but let's just say 10 years. You give yourself 5 years or 10 years. In fact, that's one of the critical things that I haven't done or didn't do, was say to myself, what's the deadline? What's the line in the sand where I say, okay, I've experimented or I've tried this. It's now at a point where it's becoming almost too expensive or it's untenable, to continue down this. Therefore, I have to go back, pack bags, I don't know, work at the airport, pick a job, but get a job, right? A formal job that pays, that I can. Now, that's also not something I did, right? So, and it's something I thought about this, funny enough, leading up to this podcast. I was like, I've actually got to sit and think about this now, because to your point, I got given X when I left. X was put into, different funds, and it's been doing okay. But I actually had a look at it. It's just about kept up with, slightly better than inflation. So it's not massive performance. The cost of not contributing to that pot over the last 7 years, I don't even know what that looks like. But I'm assuring it's going to be not good for me. Do you know what I mean?
Yeah.
Therefore, to your point, let's say at the age of 50, I either up or can start contributing or have to start contributing. How much is that? Is it like 20 or 30% now? It's hopefully not 98, because then I'm definitely screwed.
No, well, you've got a pot of money already, so
sure.
It
but
won't be
so that's assuming you had zero. Like,
yes.
So, but even so, the thing that most entrepreneurs, at least the guys that are transition out of corporate. That is such an important calculation, because, and it's not one I've done myself, where I've said, okay, I've been out 7 years, had I stayed, fine, I may have developed other problems, like a habit or a health problem. But nonetheless, the true cost of the 7 years is not just foregoing that nice salary with secure bonuses and crap like that. It's actually this, and then if I say to myself, okay, how do I recover? Because I haven't contributed at all, or I've only contributed a little bit, which I have done. I've now spun up RAs again and so on. But I don't know what the delta is. And then I need to actually, in my future planning now, say, okay, so from 50, I'm going to deliberately have to
Do X.
do that. Is it 30%, 15, 40, 50? Don't know. Like that's it. And I think that's such a critical part of this is that realizing, even if you have a basic understanding of these things, which I did have, and I think I have, I actually don't consciously think about it because I've got too many other pressures on me at the moment, how to make this business work, how to survive, how to make this thing work or stretch, this money pot, etc., etc. This is what's not factored in,
I think, what you mentioned earlier is very important. You're right. We get busy with day-to-day stuff, but I think it's that plan. So say when you left or whatever, to say it's a 5-year, it's a 10-year plan, and then once a year to sit down and say, where am I? What's happening? Has anything changed? The business is tanking. It's like blowing up fantastically.
Bank as much as you can.
What's changed? I've got twins or whatever the case might be. But you to have a plan up front, and we all know that's great. As they say, you've got a plan until people start shooting, and then it falls apart. But to change it. As your circumstances change, you change it. But to really make it the point whatever it is, whether it's on 1st of January or the 1st of March, pick a date somewhere.
Yeah.
Every year you review your plan. You say, where am I? What needs to change? What can I do? What should I do differently? And how do I manage going forward? I think that's the crux of it. Obviously I've got the skill set to do these calculations myself, but that helps. So I don't need to get it.
You know what I'll tell you? I've got I've got a broker and a financial broker, whatever that means.
I don't know.
Well, the guy that's looking after the big money and the other guy that's looking after the smaller money per se, the risk cover products and so on and so on. Neither one of them are really vested in my future planning. It's quite interesting. I was thinking again about this thing and saying they're almost doing it retrospectively and reflectively. They don't look and say, I'll get a performance review of my portfolio that says in once a quarter, and they'll say, bad quarter, good quarter, wada. None of it actually says, listen, as a result of where you're at, even if the markets do better later and so on, you still got this gap that's opening up, right? This delta. Nobody does that. And they're not doing it like proper financial plan. I haven't yet seen a proper financial planner who comes and exactly to your point says, dude, once a year for half a day, we're going to sit and we're really going to go through where you're at, all right, relative to where you think you want to be. And I'll tell you what's scarier, because I've also, as I said, I've now, been on this journey for 7 years, met a lot of entrepreneurs. Some guys that came straight out of varsity into entrepreneurs, other guys that did what I did, but at different points. Most of them are pretty much screwed. And I promise you, because they're all gambling on the fact that they are going to get a massive payday somewhere down the road, okay? Because the thing that they've invested in or working on is going to make it. And they'll get this big payday, and that'll backfill, the 20 plus years or the 10 years or the 5 years of no financial planning whatsoever. I think that is just ludicrous, honestly ludicrous. Like there's this mental block where they don't even want to think about it, like in a weird way, right? Like they're just like oblivious to it and say, well, I'm going to get the payday. I'm going to back myself. Because that's what entrepreneurs are. They do back themselves. They're massive gamblers. But that's not smart, right? Like I haven't yet to see any of them say, honestly, well, I didn't make it, 9 out of 10 startups fail. That payday doesn't happen. And then what they never did was they never put anything away for that reality, because either they want to ignore it. It's easier to say, look, I'm going to be the 1 out of the 10, right? And believe I'm going to get a big payday and a big check and exit bonuses and blah, blah, blah. And therefore, that's what they plan for. That's the plan. It's an all or nothing, all in. And I just don't know. Unless you're living in a great country that's got a fantastic social backup for you, which, to be honest, some of them have, right? Like, I mean, I speak to guys that live in Finland or in the Netherlands or in Australia, whatever. US maybe not so much. And yes, for some of those individuals, there is a the government has got a reasonably secure backup. Not great, by the way. I mean, you don't live a great life, but you have options. But then I tell you, there are countries like this one where there is zero, right? Zero. You're going to get 768 Rand or whatever on your grant that you get from the government or whatever. I think that's the scariest thing of all. If I reflect on being an entrepreneur and who I've met.
It's tricky because on the one hand, you're right. I mean, the entrepreneurs by nature, in order to be successful, you have to be confident in yourself and you have to keep banging your head against walls, people saying, no, you can't do it, it won't work. And then your first business fails, but you learn a whole lot and you try again and you apply those learnings and so on and so forth. So, But at the same time, you're right. You can't be oblivious to the fact that
100%.
the vast majority of startups aren't going to be successful, and it's how do you get that balance between, and I guess it's even more important if you're on your own, fair enough. But if you've got a family and
if you were 25 again,
husband and kids,
if you were 25 again,
yeah.
I actually put it this, time is both a blessing and a curse, because at 25 you're invincible, you're going to have this big exit future plan and blah blah blah, and you go all guns blazing, right? And you live like a cockroach and you eat very little, you sleep on people's couches and all that, which is true because you don't have those other responsibilities, right? Before you wipe your eyes out, and I've seen this, right? You're not 25 anymore, now you're 35, okay? It's 10 years, that's why I say, what's the cutoff point? What's the line in the sand? You're 35, you're now maybe looking at marrying, okay? And I love this discussion because I've had it with millennials and all these wonderful ideals that people say, we're not into buying things, we don't want to buy, we don't own things, we'll just use things. I'm like, okay, great, let's see how that works out. And then true as nuts, they get to 35, they get married, what do they want? They need a house, okay? But it's like, but I thought you were not going to own anything, and then when they have kids, it's like, now so it's funny, there's this sort of narrative that people have created for themselves, which I just don't think is, it's distorted. It's a distorted narrative. And my worry for them is that this catches up with them when they're now in their 40s and they've got zero planning, zero backup, zero planning, and they still got the same, this is the definition of man, they're doing the same things, expecting different results, right? And I think when you have that time, which is a blessing and a curse, the curse, of course, is that you think you will recover later. The reality is that your recovery has to be spectacularly better because you've just not taken a little bit, and it's never too late to start. And I think that's the other thing is, start now, start today. Even if it's only a little bit of money, do something with it, sacrifice it, because if you don't, you will be that guy at 60 that will be not in the best position, especially in certain countries. And you don't want to be there. I've seen it, again, you can watch the story. I've spoken to a lot of people, who've not made it. Don't go talk to the guys that have made it. Do you know what I mean? It's almost like, because that's that false hope or false sense of reality again as well.
There's no doubt. I mean, let's say you are going to be one of those guys. What's the downside to putting a little bit ahead?
Zero downside.
You're giving up a couple of coffees or eating out once a month or whatever. You know what I mean?
100%. Even if you want to say your backup plan is buy a lotto ticket every day, I don't mind. But the point is, don't do yourself a favor, right? If you're going to go down this road, don't go talk to the people that have won. Go talk to the people that have lost. And go get that reality and then plan for that. Because then at least, if you're the 9 out of 10 guys that don't make it big, you're not going to be destitute. Do you know what I mean?
Well, I think it's very good of you to promote the the powers of compound interest. That was supposed to be my job.
Well, I think it was Einstein that said the greatest gift to mankind is.
It's attributed to him, whether he said it or not. No idea. But
we'll never know.
But it
just sounds better when you say Einstein.
Eighth wonder of the world is supposedly what it
Yes, that's right.
But it is you saw those percentages I mentioned. So the one was at age 25, you can contribute whatever it is, 11.8% of your salary, and at age 55, 98% of your salary. So that gives you an indication. But I do think you're right. Obviously, starting the sooner the better. It's like there was an analogy I heard the other day. It's also, even if your age and you hadn't saved anything, it's never too late to start. It's like your health. Rather look after your health when it's all the time. But if you're 50 and you smoked, stop now and you'll still be a hell of a lot better off.
I wonder, if the reason why people don't do it is they're afraid of the answer. So let's just play this out quickly. Let's say I'm 47 or 42, doesn't matter. Let's say 40s, and I've not saved at all, zero, right? I've gone the all-in route.
Yeah.
Okay. And no payday yet, assuming. I go do this. I get a reality check, and it says, the plan says, the maths says, you got to put 50% away. And I wonder if people don't do that because they know the answer is going to be like something horrendous, like let's say 50.
Or they even get the answer and they're going, that's impossible.
Exactly.
Yeah, I shouldn't even.
So then it's just what they say, ignorance is bliss, right? So now I'll just be blissfully ignorant. I think that might be one of the key reasons why people maybe are not doing it. I think it's still not the right thing to do though, in that sense. I'd rather go and say, okay, crap, it's 50. But I can't do 50 right now.
20, whatever.
But then I must do something, And maybe the again, given the right advisor and so on, you may say, well, if it's less, because by the way, I've also seen this. I've seen with my mom, for instance, she for 28 years religiously paid 80 Rand or 20 Rand a month. It was a small number every month, believing that was going to be worth something.
Into retirement annuity.
I don't know what it was, to be really honest. Yeah. But at the end of the day, it ended up being worth 100 grand, or something silly. So I also think if you're going to do this, and you're going to, because it's going to be painful, right? Doesn't matter what the number is, especially if you in that bracket of age, then at least go and make sure that it's going to be worthwhile, in the sense that put it into an aggressive fund then. It's no point in being 42, putting in 20%, let's say you can even afford that, let's say even at 10%, and then putting it into a conservative approach, because you're like, well, and I know you've got time and so on, but you're going to have to put some gambling in there, or at least spread it, and how you spread it would be different.
So, I think you highlight an important thing. Obviously, if you're doing it via a retirement annuity or any form of retirement funding, then you are constrained by Regulation 28.
Yeah, correct.
So you can't stick it all in whatever.
Choose your vehicle.
S&P 500. So, but I wouldn't call it gambling, okay? So, the other retirement vehicle, which I would recommend to everyone who...
That's why I'm not giving advice, by the way.
To everyone who is younger than us.
That's mostly almost everyone.
So if you're a young entrepreneur or a millennial, would be a tax-free savings account. And the difference between the two is most people say, but surely you benefit if you put it in a retirement annuity because it's, you're effectively not paying the tax on that money. And I say, well, yes and no, because the retirement vehicle is constrained. Okay, so the most you can invest in equities is 75%, and the most you can invest offshore is 45%. Whereas through your tax-free savings account, if you wanted to, and if you had a long enough time horizon, if I was 25, I would put 100% of my money in a S&P 500 ETF or a MSCI World ETF.
Oh, interesting. Okay.
And because there are no constraints, obviously you can only invest 3,000 Rand a month.
Sure.
Or 36,000 a year.
By the way, that vehicle you're talking about now, I've now started taking out for my kids.
100%.
And I think, again, if you're a parent and an entrepreneur, and you don't do this for yourself and your wife, for goodness sake, at least do it for your kid, right? Because you can set them up for life. Not, it can't be the only thing that they have, but holy cow, that's got to be the best and only and first thing. If you're going to sacrifice even 3,000 a month, that's the 3,000 you sacrifice. I totally agree with you.
Yeah, so
I made a mistake. I didn't realize that again, nobody told me, right? And I had too many other things that I was thinking about. This was the last thing I thought about, to be really honest. What I should do for my kids or what products I should buy. I've been spending an unbelievable amount of wasted money. I think it's wasted, but I didn't die, so yes, you can say that now. It's riches. But even on short-term insurance products, if I think now I've cut, and this is probably something you should also do every year when you do your financial planning, is review these products. Because
100%.
I went to my broker now recently, and I halved my premiums. Not my benefits, funny enough. Just by rejigging the benefits properly. I didn't halve the benefits, but I halved my premiums across medical aid, short-term, and these risk products. And I feel like I'm actually in a better position now. And what I will do now is take that other premium that I was then pushing and push it into these other kind of vehicles.
Yeah, I think, for me, the tax-free savings account, as you pointed out, is fantastic. Compound interest really, so if you have a 6-year-old child and you're investing for them and you use up their lifetime by the time they're 20, that the most important thing, which is obviously you can't guarantee it, but is to strongly educate and encourage them not to touch that money until they retire. The numbers are astronomical. Normally we don't look at projecting or looking at the impacts of compound interest further than maybe 40 years. So if you're a 25-year-old and you're projected to 65. But if your child was born today and you started investing...
You see, that's the mistake I made. When he was 12, or I don't think it was around then.
It came out in 2015, 2016.
Yeah, I was just going to say it was about 3 or 4. But that's the first thing I should have did, right? When my daughter was born, it's the first thing I should have did with her, And funny enough, my wife said, because it ends up being 36, per kid, and also now I've done for me and my wife anyway. Although honestly, it's not going to be that.
Unless you wait until you're 70.
Well, I am. I literally will be, because remember at 60 my kid will be matric. Just as a point in case. So that's why I say even now, it's never too late, right? And if you're a young entrepreneur and you have a young family or you're starting to have a family, for goodness sake, this is the one thing you just must not compromise on. Take the product, budget the 3,000, non-negotiable.
Or if you can't afford 3,000, whatever.
Yeah, absolutely. I'm just using that number as the match, right?
Yeah.
But it's again things that nobody advised me on and I didn't think about, right? And that's my regret in that sense, is that you really need to find a good financial planner. You need to find a good tax guy as well, by the way. That's the other thing I'd say is, but find a financial planner and this will be difficult, but I'm pretty sure they must exist. But you need to find somebody that's also going to be willing to commit to that half a day of not retrospective, but looking forward and saying, look, this is where you're at. And I think the one question...
I don't know that they need half a day with everyone. Maybe with you, Dylan, because you talk a lot.
Dude, probably. I'm more thinking just investing the time.
I agree.
It can't be a half an hour coffee discussion either, because the problem with that, and I've seen the guys that do that half an hour coffee, whatever, they're just really not explaining things. And so they just say, oh, look, I plugged into this Excel spreadsheet or my model and here's the answer. And that doesn't help, right? Because you're like, well, what assumptions did you make? What assumptions? Just give yourself more than an hour. That's all. It's once a year. Honestly,
I agree.
It's not like you need to spend.
Just coming back to what you said you're right that putting something away is critical. I think the other important thing, and it talks to the risk component, is what you invest in. And over the long duration, the impact between a fixed interest return, call it 8-9%, whatever, and a long-term global equity return. I'll refer to the S&P 500, which is very well diversified in one sense.
In fact,
it's the biggest 500 companies in the US, but it's also quite concentrated in terms of they are all
US. The S&P
US.
500 performed as well as Warren Buffett's Berkshire Hathaway. They've actually shown
in the last 20 years marginally outperformed.
Exactly.
Yeah.
Outperformed the leading expert in investment, Buffett, right? So I totally agree with you.
But only in the last 20 years. If you look at since Buffett started, he probably has doubled or nearly doubled.
Sure. He made some other bets and so on. I just want to iterate the fact that those sort of funds are smart.
Yeah, you know? And I suspect that after the last week that our performance has swung around.
But you know as well as I do, never look at a small window.
Correct.
Everything in the markets, but unless we get to the AI killing us.
But my point is the difference between those two, and I did the numbers for an article the other day, is I think it's something like 40-year time horizon investing in fixed interest versus global equities, kind of best guess of what those would be over the long term. And I don't know the numbers, but I think the multiple was 9 times. So if you stuck it in like an S&P 500 and versus in a fixed interest fund, you'd end up with 9 times as much money after 40 years. And it's mind-boggling.
It's also funny, you know, the one thing that a lot of entrepreneurs that I know tell me, but they've got their property as their retirement fund, right? Like, you know how many times I've heard that? It's like, but I've got this property, that's my backup plan. I'm like, first of all, that's assuming your property doesn't go to nothing, because real estate, and if you think about what happens in South Africa, where you can be in a prime property today and tomorrow there can be a low-cost housing development going up, and then Hout Bay was a good example of why I de-risked myself by getting out of there, you know, just because, and I mean, it has bounced back and so on, but it's such a false sense of security that it's like, I have my property, you know. I have it in my portfolio. I know what my property is worth, because I know that for me to even benefit a fraction of some future state of where I can use that, I've got to downgrade massively into something else. Assuming that property, and it will, as to your point, it's never going to perform 9 times.
No, I think different people view properties differently. I mean, I'm in your camp. I own it. It's probably way overcapitalized.
Yes, yeah.
I enjoy living there.
Sure,
but I definitely do not. I do not consider it as part of my. It's part of. It's an asset, but it's not an investable asset that I can say I'm going to draw an income from.
That's all I'm saying. You know, a lot of guys believe that their retirement is their property only.
Yeah.
You know what I mean? And I think that's also not a great position.
So, I mean, we've had a great chat, I guess. So I think 2 questions. One is, like, if you could look back, I mean, what would you say you would have done differently with the benefit of hindsight?
I would have been a lot more aggressive in how I spent my money between the risk products that I bought and the, you know, balancing that premiums better between that and retirement.
So you would have put a greater proportion.
100%, yes. And I think secondly, I would have taken out that tax-free savings product immediately, like the day.
Well, yeah, I mean, I only took it out about a year after.
I mean, it's honestly one of my regrets. And the nice thing though is, even although regrets are useless in our psyche and so on, but like for my kids now, I'm talking about specifically, I've now done it. And I've said to my wife, I don't care what happens, we have to sell cars or whatever we have to sell, that 36,000 is going every year for the kids. You know, even if we have to cut our hours, which I don't think it would be smart either, but definitely. Those are my 2 regrets. Okay. And probably talking to the wrong people, but not knowing they were the wrong people. You know, that's the trickiest of all.
But I think the one thing you said kind of sticks with me, and it's like anything, I guess, is if you were to buy a house, you wouldn't necessarily go and buy the first house that you saw that you liked. You'd like you would go and check, so it's the same thing with a financial advisor. So it's like, how would you
do a rigorous robust,
and what is that involved? And
exactly.
I am a financial advisor, although that's not my primary primary role. But I've never, people have asked me, what would you recommend? What are the key things that you, and it's difficult. There's no obviously you want them to be competent, you want them to, I think one of the most important things is they got to listen to what you say, and if someone can't explain or answer your questions to your satisfaction, then you probably have a problem.
I think just on this financial advisor interview process, right? I had somebody come the other day to sell a very creative investment vehicle. It's quite interesting. It's offshore. Maybe there's two separate points here. One is don't be so myopic in just looking at vehicles or instruments in South Africa or in your country, right? Just go a little bit broader, because there are some, as is the case with this vehicle, it's an offshore vehicle that I find is quite creative and interesting, and make sure that you've explored enough, or at least your advisor explored broader than what's available. Yeah, right. But what was interesting, and this was very bizarre, when I asked the advisor, have they bought this thing? Have they put their money in? And the answer was no. And I said, oh, why? And then there was a whole lot of stories about, but I'm doing this on my house and blah, 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 fish face. And I was like, that was immediately the first red flag. Then they brought the product owner to talk to me, the guy that's promoting the product. It's not their product per se, but they're distributing the product. And I asked him the same question. I said, hey, how much of your money is in it? It's like, well, I'm currently, and then I'm like, no, big red flag, And the reason why I raise this is purely this. Nobody loses sleep like you do over your money. As much as they will say it, I promise you, the only person that truly cares about your money is you. And I learned that lesson from the first guy that advised me and made lots of money for himself. It's an important lesson. I learned it at least then, was to say, because when the markets go down and when this goes wrong and when this, it's your money at the end of the day, not theirs.
Yeah.
I
think you're right, and I think that is a critical question that
at least that should be the question
you should ask of the financial advisor is, what products do you have and why? Because the why is important. So if I look at my career, like as you said, I've worked for corporates for the vast majority of that. So I didn't need, I had retirement saving stuff in place. I didn't need any RAs or anything like that. I had risk benefits in place. I have purchased life cover for myself when I left one employer and moved to another where the structure of the risk benefits was different. So there was a gap. So I did buy life cover. And recently, when I left the corporate environment last year, I bought myself a small amount of CI. I think it was less than R1 million or something like that, just in case. Didn't need income protection because I basically am retired, even though I'm still working.
Yeah.
And I have some life cover in place for estate duty purposes, but I didn't need to buy that. So, but it's a good question. So, in my life, what financial products in the life insurance space, I've always had short-term insurance, I've always had medical aid and gap cover and whatever, but what financial products have I purchased for myself? Tax-free savings account for my children and myself when they came out, or a year later. I was a little bit slow to jump on the bandwagon, not as slow as you.
Well, there you go. You're definitely smarter than me.
Not smarter. It's just that's that's my field.
There was space.
So it's not like if someone had sat down with you at the annual review and said, "Hi, Dylan, this new product has come out.
Yeah.
Are you interested? These are the benefits." You know what I mean? Then it's not smartness. It's unit trusts I've used throughout my career for. Discretionary money. So it's like savings that are not sticking into the insurance net. Other investments, well, they are all pretty much unit trust. And you mentioned your own money, and that, so I used to invest a lot with Alan Gray. I knew Alan Gray personally. And some of my money is still with Orbis overseas. But the interesting thing about them is their money is invested in their funds.
Okay.
Now that's a huge.
Yeah.
I mean, the Alan Gray family have a chunk of their change invested in Orbis, which is, as you say, it's like put your money where your mouth is, and I'm willing to back that. I'm trying to think what else financial products. So and there are. I mean. So I might not, if I, as a financial advisor, I might not recommend to someone that they use unit trust versus a insurance savings vehicle, but that wouldn't be because I think it's a good or a bad thing. It would be because of that person's aptitude or to not dip into the fund. So I mean that's one of the big risks of unit trust is it's readily accessible. I mean it's great. But
so if you're not
disciplined, enough, maybe I wouldn't recommend that to someone. But if you are disciplined, I mean, these days, there are fantastic platforms out there where you can invest in pretty much anything under a single vehicle, and there is you paying for that flexibility. But some people it's worth it, others it isn't.
Yeah. Just while you raised that, just as something that I remember now, I also learned the hard way was whatever platforms you're using and whatever platform your broker is using, scrutinize the costs. It's crazy, and it might sound like it's not a lot, like they say, we only take 0.5% or 0.7 or 0. This or 0. That, so you're like, that's, who cares, you know what I mean? Let me tell you, when you add up all the 0 points somethings across the broker's costs, the platform costs, this guy's costs, etc., it ends up costing you almost 2% now, or 1 point something percent. And let me tell you, that compounded over time is astronomical. So again, think about this, and I realized this again just as this basic analogy. When I walked into some of these big insurers' buildings and head offices, and it was paved with, the toilets had marble all throughout the toilets, I realized these buggers are making more money than what they're making for me. It's as simple as that, right? Like, they're not there for charity or to look after me as a Dylan. They definitely there to look after their shareholders and make good profits, and they do.
I mean, I think two things. One, I think the fees have come down dramatically in the last 10, 15 years.
Yeah, that's true.
Which is also probably why historically I invested in unit trusts.
Again, smart man, yeah.
But, and the point you raise is an important one. I mean, fees are critical. I won't mention names, but the other thing which I didn't realize, so I'm thinking a lot of people out there who may be in a similar boat, is you need to look not only, so maybe it's a great fund, okay, you invest in that fund, but then there are different classes of that exact same fund, okay? And the fees on those different classes can be quite dramatically different.
Interesting.
And I found out to my detriment that I was investing some money directly in the unit trust, so not via a platform. And the fund they had available for their direct customers was 0.75%, 0.75% per annum charge, higher than you could get if via a platform. And the reason, I can understand it being a little bit higher, but the reason for that is that you're investing your little amount of money and the platform is investing tens, hundreds of millions of rands, and so they're getting a difference. Now, I'm just going to use Easy Equities as an example because I happen to know what their platform fee is for unit trusts. It's 0.25%. So in that example, you can buy this exact same fund via Easy Equities, and you're getting a 0.5% higher return.
But Bernard, isn't this an interesting one? Because I'm like, wow, that's massive. It's 0.5. Like most people look and think, what are you kidding me? Like, you're talking about 0.5%? Like, really? I'm like, yeah, take that number, compound it over time, and it becomes 20 or 30% less, like depending on how long time is. But I think this is also what people don't know, or they don't think it's important. But let me tell you, like 0.75 to 0.25, that's a huge difference over time. Definitely, that's why I think, they're like, well, as long as you outperform. You're like, no, that's additional 10 10 or 15 or 20% that I lost over the bulk of the money.
Yeah, you raise a very good point there. I'm trying to just do a quick.
Oh, you want to do the numbers?
Let's do a quick number.
Yeah, make it real.
Off the back of and I'm doing it with a high return, so
Sure.
the difference will be like less. The
Sure,
marginal difference will be less. So this is a 40-year investment, and you're getting 14% less.
Yeah, that's massive.
Yeah.
14%. So let's say eventually that thing was worth 10 million. Just keep the maths easy, right? So in 40 years, you paid out 10 million. You lost 1.4 million then.
Yep.
Right? 1.4 million. That's why 0.5% matters.